Hi, I'm Jenny Brown. Welcome to this week's MFB news. I hope you are keeping very, very well. Sorry not to have been around last week. I had a week in Mallorca. Don't be jealous. It rained every single day. Certainly not the break that I had in mind. No suntan here, but it was nice to get away nonetheless, and I know I'm very lucky to have done that. The kind of logistics of travelling at the moment, I know a lot of people have been asking, is it very complicated? Is it very difficult? Actually getting back into the UK was really quite straightforward because we're vaccinated. So we literally caught a flight, ordered some lateral flow tests, which we did 2 days after we returned. And there is a form that you have to fill out, but honestly it really is nothing to be afraid of. And actually in Mallorca and in Spain more generally, everybody wears masks in any sort of community spaces, so in restaurants, apart from when you're sitting at tables and all the shops, and they're very, very strong on this point as well. So actually what I would say is that while you're over there you feel very, very safe. Anyway, enough about my holiday. We're not here to talk about holidays, we're here to talk about the buy-to-let market and what's been going on. So this week for you, we've got some updates on pricing, some updates on criteria, all very, very positive stuff. We've then got a brief update on the rental market and also the house property market as well for you. So good stuff to cover off this week. Okay, so first up, Keystone have made some changes to their product offering, introducing a new cashback incentive, which means that every application would enjoy a cashback of up to £2,000 on completion. Now, Keystone have some really good pricing within the space that they kind of dominate, which is the specialist end of the market. So pricing starts from 2.79% on their green range, 2.89% on their standard range. Now, as a lender, Keystone are, they're definitely specialists. Look, so they're able to lend on HMOs of up to 10 units, bedrooms, multi-units of up to 10 self-contained units. They can lend to SPVs, layered SPVs, they can lend to trading companies, they accept holiday lets, they don't mind how much you earn as long as you're earning something and you can demonstrate it. They don't mind how many properties you've got in the background as well. So a really, really solid offering. And I think if I was asked to kind of give you the kind of ethos of Keystone and what they're all about, the way that I find them is that they are very, very good at leaning on technology to improve efficiency, but actually they really, really retain the human element of underwriting. And so the underwriters there, I mean, I know some of them from, donkey's years, how long I've been working in this industry now, and they're really, really experienced. And what they are kind of get empowered to do is make some very commercial decisions in terms of the kinds of cases that they want to lend on. So the fallout of this means that actually we've been able to get cases through with Keystone that other lenders wouldn't necessarily have considered. Not because they were bad applications, but because they weren't simply ticking the right boxes, whereas Keystone were able to take a more rounded view on these applications, which was really nice. So if you lump that in with the fact they've got some really great products at the moment, particularly with this lovely cashback, actually a really, really good solid offering from Keystone this week. We also welcome a new lender into the 80% loan to value lending space. And I always get quite excited about 80% lending, or when lenders re-enter that market, because it really just kind of demonstrates a confidence in terms of the housing market and what's going on there. Lenders don't increase their loan to value appetite if they're expecting house prices to tank. So the fact we've seen another lender come in at 80% is super, super positive. So Fleet are back in the game there at 80%, only on standard properties, so not 80% on their HMO multi-unit offering, which they do have incidentally, which is very strong. And the pricing at 80% starts from 3.89%. Now look, in terms of 80% lending, you can get cheaper rates with the more kind of high street institutions, 80%, put my teeth in today. But Fleet are a specialist lender, so they would be able to lend to your limited companies, layered companies, landlords with more than 4 or even 10 properties, no problem. They don't mind how many you've got. They do want you to be earning income of £15,000 a year if you're an experienced landlord, i.e. you already have a buy-to-let property. If you're a first-time landlord, you need to be earning at least £25,000 a year. Now, in terms of their lending policy and some niche bits and pieces for you there, they can do day one remortgages. So you buy a property today, you do some work to it, you want to remortgage it in 3 months' time, they can do this for you, that's no problem. They're fine with the more kind of unusual tenancy types. They're okay with DSS tenants and housing association lets. They're also open to ex-local authority flats, flats over commercial, and also ex-local authority houses as well. And there's other bits in their lending policy as well, which are really, really strong. But the key news is that Fleet are back at 80% loan to value. Paragon have been on a bit of a mission over the last week and made lots of changes to their products and also their criteria. So first of all, what's changed? So they have increased their maximum loan amounts at various loan to values. So as an example, at 65% loan to value, they've increased their maximum loan amount from £2 million to £4 million. At 70% loan to value, they've increased their maximum loan from 1 million to 1.5 million. So basically the amount you can borrow at various loan to values has just increased, which is really encouraging. Now they've also, keeping on a bit of a theme here, gone back in with some new 80% loan to value products. So previously they were only doing 80% loan to value for green properties, so EPC ratings of A to C. They've now actually broadened that to incorporate non-green properties as well, albeit the pricing isn't quite as good. And they've also refreshed their whole product range. So basically their pricing now starts from 2.95% for green rates. Anything which is not green has a 0.1% loading. So comparatively, on 80% lending, a green property EPC rating of A to C would get a rate from 3.99. Standard property at 80% non-green would be 4.09%, to kind of give you an idea of how that lands. On their 80% products, what's really nice here, despite the interest rate probably not being, you know, the most competitive, is they have no arrangement fees, which is really, really good. Now they've also gone into expat lending. They were in that market pre-COVID. They've opened that back up. They're able to do expat lending for limited companies as well as individuals. They say that the applicants must have a current UK passport and had a UK bank account for a minimum of 3 years, and they would not consider any applications that would qualify as consumer buy-to-let. Now, consumer buy-to-let really incorporates all buy-to-let mortgage transactions which are to finance a property which was not deliberately purchased to be an investment. So I'm remortgaging the house which I currently live in as a buy-to-let. I've inherited a property, I'm going to remortgage it as a buy-to-let. I didn't deliberately acquire that property with the sole purpose of renting it out. So that's what that means. Incidentally, on consumer buy-to-let, it's a term which, you know, people have slightly different interpretations of this terminology. If you fell into the realms of consumer buy-to-let, don't worry about it. There are lots of lenders who do these. Paragon do them ordinarily, just not on their expat range. So while this is relevant in the context of what we're talking about here, actually, you know, it being a consumer buy-to-let isn't a massive drama by any means. So look, you know, Paragon have been really busy. They've refreshed their product range. They've changed their criteria. What they've done there is actually quite bullish. I'm really pleased to see it. And it's great that they've actually reintroduced a pre-COVID requirement as well, which is fantastic. So great job at Paragon. Now, lastly, on the lender side of things, we have seen a couple of lenders withdraw some of their limited edition products. Now, just to recap, limited edition products are where a lender brings out a rate which is going to be more competitive than their standard product range, and it's available for a limited amount of time. Well, actually, that's not true. It's limited amounts of funds that are available. So, for example, Aldermore might say, okay, we're going to bring out this really, you know, lovely rate, but we're only going to lend £100 million on that basis. And once we've secured applications to the tune of £100 million, we're pulling it and it's gone. So Aldermore have removed 4 of their limited edition products in the last week, and they have not yet replaced them. I'm sure they will, but what that will look like, we just don't know. And the mortgage lender have also withdrawn some of their limited edition products as well. So again, they haven't replaced those at the moment. What does this mean for you guys? Well, look, you know, hopefully the new rates that come out are going to be relatively good. Ideally they'll be better, but I think that's quite unlikely given what's going on with pricing at the moment. But we'll keep you updated when we know what these guys are replacing them with as and when it lands. The other thing I just wanted to mention in terms of criteria changes, which actually is quite a nice one, is that Precise have expanded their criteria on bridging finance. So they're now increasing their maximum loan to value to 75% on all their bridging range. It was at 60% loan to value. Where we do a lot of business with Precise on bridging finance is on their refurb to let product. So a kind of quasi, well, it's a two-part loan essentially. So a bridging loan at the start of the application with a pre-underwritten exit onto a term mortgage, all with Precise. Why are these popular? They're really, really good because people like the surety of knowing that once they've finished whatever it is they need to do on the property and the bridging finance arrangement, they have a guaranteed exit onto a buy-to-let mortgage at the end. What Precise also do, which is quite nice, is that you can exit onto the buy-to-let mortgage at any time, but at that point they're going to increase the maximum loan to 75% of open market value at that moment in time, if that's what you want to do. So really, really nice offering. But what we had found is that the 60% loan to value was too restrictive for some people on the bridging elements. They're back up to 75, which is really, really good. Okay, some rental market news, and for once, and I can't remember the last time I had this, I have some good news for London. So data suggests demand for tenancies in the capital is at an annual high, with 35% more tenants registering for properties over the last 12 months against the previous year, also inflating rental charges by up to 15%. Now, specifically in London, the areas which have seen the kind of highest inquiry levels are Camden at 128% growth, Hyde Park at 45% growth, and Canary Wharf at 38% growth. Chesterton's have said that there are 68% fewer properties to rent this in September 2021 than there were in September 2020. So they're seeing a notable increase in demand for rental properties in London. People are obviously coming back to the city to work now, and things are kind of really, I guess, coming back to life. But there are actually significantly less properties available to rent on the market, which is really driving up the rental prices. So yeah, look, it can only be a good thing for those investors in London who've had a really kind of quite tough time in regards to letting of properties over the last year. We'll keep you posted on how that develops, but really, really good news for our London investors. And lastly, just shy of 7 out of 10 landlords, 69%, have reported record levels of demand from prospective tenants in the third quarter of the year, and that's based on research from Paragon Bank. More than a third of those landlords said that the increase in demand was significant too, with landlords in the southwest, so 79%, and southeast excluding London, to 74%, seeing the most dramatic demand jumps. So again, really, I think what's going on there is really just echoing what's happening in London at the moment in terms of demand really, really increasing. And absolutely, as we all know, as demand increases and really outstrips supply, what that does is push up prices. And I think, like I say, obviously being mindful of tenants in all of this as well, but actually from a landlord's perspective, it has been quite a tough time for some, particularly over the last 2 years. And so I think it's actually really nice to see some really good news in terms of rental demand for our landlord clients, really just giving them some reassurance that the property market is, remaining very, very robust as we go, or we exit 2021 and move into 2022. So look, we'll catch you next week. As always, if you have any questions, give us a call, 0345 345 6788. And as always, there's lots of information on our website. Please do go and have a nosy round on there if you've got some time, see if there's anything useful for you. And I will catch you again next week. Look after yourselves until then.